and thank you all for being here. I am genuinely grateful that you've chosen to spend your valuable time with us today. It's a pleasure to see familiar faces, those who I've had the opportunity to work with directly, but I'm equally looking forward to meeting many of you for the first time whose names I've come to know through the work that we've done together on your behalf. As I prepared for today, one of the things I didn't anticipate was the level of introspection it would require. It forced me to slow down and to spend time in deeper thought and reflection, connecting experiences, life stages, influences that, in the moment, didn't always feel significant, but have clearly shaped who I am. That process, in and of itself, has been truly meaningful. And so today, I share with you part of my life story. And I'm that little fella there in the turtleneck. Mark and I had similar upbringings that we were both raised in households where there was an awareness of money. My mother was mostly a stay-at-home mom, though she did have some part-time jobs as a bookkeeper. And my father worked in commercial real estate property management, and he held that same job throughout my entire childhood. He taught me the great skill of being a creator, of making things with your own hands, of doing things for yourself. Through him, I discovered the fulfillment of building something out of nothing, and the deep satisfaction of learning new skills. The awareness of money was reflected in the wisdom that was imparted upon me. He taught me to value every dollar because it's a finite resource. Whether it was fixing a sink, working on a car, building a deck or a fence, we rarely hired anyone to do something that, in my dad's mind, we could do ourselves. I was taught to be capable, resourceful, and I'm very thankful for this upbringing, as it taught me many skills and stoked a natural desire to build and to earn. This passion for building, whether it be something tangible like a fence or intangible like a financial plan, still burns within me today as much as it ever has. In the work that we do, it's an ever-changing landscape. Constant changes to the tax code, secular shifts in the economy, and major changes to your life circumstances. It becomes a continuous cycle of learning. Every day, we are tasked with distilling complex concepts into usable strategies for you and your families. The other highly impactful influence in my early life, and to this day, has been my grandfather. Growing up, he was generally not a man of many words, but when he spoke, everyone listened. By profession, he started his career as a stockbroker, but soon came to find that sales element was not something that he necessarily enjoyed. So within the bank where he worked, he identified portfolio management as an area of interest. The stock market had always been an area of interest to him, as his father, who was a farmer, would drive from a small town in South Carolina called Pageland up to Charlotte, North Carolina to purchase futures on watermelon contracts that he was growing, ensuring the price he would receive for his crop was appropriately hedged. During these trips, his father taught him about stock ownership, so my grandfather began buying stock certificates in the companies that he was familiar with. This experience ultimately defined his career. These stories and countless others inspired me and helped shape my love for investing. As he moved into wealth management, he became a disciple of Warren Buffett. At this time, Buffett was not well known in the investment community. He was not yet the Oracle of Omaha, as he is known today. And during the 70s and 80s, my grandfather quickly developed a noteworthy track record of investment returns. He became responsible for managing several employee pension funds, and notably, had a full-page interview in Fortune magazine. He was not part of this writer that Jay talked about earlier, in 1986. From there, he was asked to manage a large charitable trust in Charlotte and did so successfully for several decades. He even still continues to serve as a trustee today at age 90. When I was young, he began to teach me about the importance of saving and investing. At Christmas, he would give a small amount of money to my brother and to me, and told us that if we gave it back to him, he would double it and invest it on our behalf. Seems like a pretty good deal. I didn't realize this at the time, but that gesture was so influential to me. It became to me what the trips to Pageland, or from Pageland to Charlotte, were for my grandfather. This was my very own watermelon moment. Over time, I was able to see the benefits of saving and investing through this lesson. As I became older, I developed a growing interest in investing and an innate curiosity. I found I listened more intently as he continued to share more defined wisdom about security selection and the value investing discipline that he learned by being a Warren Buffett disciple. As fate would have it, it is the same investment discipline that Mark learned during his time at Duke and has used for several decades for our clients at Kuhn Advisors. What was instilled in me at an early age now becomes a significant part of my life's work. But it wasn't only a lesson in compound interest. He taught me a great deal through example by the way that he lived his life. He lived in the same house, drove modest cars until they wore out, and most importantly, he was always supportive of his family in times of need. He was not only generous to us, but to other members of our family and to organizations that he supported over the years with both his time and resources. He taught me it's not just about the accumulation of wealth, but about generosity, stewardship, and responsibility. Money itself isn't the end goal. It's simply a tool to help you live a meaningful life and to help the people and causes that you care about. In many ways, Mark embodies these same characteristics that I've always admired in my grandfather. Many of our clients also share these same values and embody a great sense of generosity. This inspiration from my grandfather and from you all continues to motivate me in this business. And after more than a decade in this industry, I can say these are the qualities that I truly value, and they form the core ethos of my work. After graduation, for me, it was not the best time to be looking for a job in finance. It was 2011, and the economy was still recovering from the global financial crisis. I wasn't exactly sure what I wanted to do, but I did know I wanted to work in finance and was willing to start just about anywhere. I ended up landing a job as an analyst at Credit Suisse, working in risk management for their investment banking division. At that point, I was solely focused on working as hard as I could and moving my way up the ranks without a clearly defined end goal. After a couple of years, I was promoted to senior financial analyst and several years later to assistant vice president. At that point, I was also responsible for managing about 6 other analysts. I felt I was making progress based on title and trajectory, but something was missing. Working with institutional clients, while interesting, was not bringing me fulfillment. It didn't feel as if I was building something meaningful or helping affect change to help others. In addition to that, I found constraints that were levied upon me that naturally materialize with an organization of this size and scale. For example, I didn't have the autonomy to give what I believe to be appropriate compensation increases to my direct reports, who I thought were doing a wonderful job. Additionally, The company touted innovation, yet when I offered new ideas, they never followed up to discuss them. Despite the dissatisfaction with some of these elements, it ultimately took the experience of a global pandemic and attempting to manage a team of analysts through Zoom and through the Great Resignation to push me to the point where I was ready to make a change. I identified financial advice and planning as an opportunity to do exactly that, leveraging my existing skill set while also fulfilling my desire to build something impactful and to continue my pursuit of knowledge. Even so, there were no guarantees that wherever I landed would provide that opportunity. And I knew I'd likely have to take a step back compared to my position, title, and compensation at Credit Suisse to begin this new path. To me, it was a significant risk. I had built credibility at my firm, I had just gotten married in 2020, and we were thinking about starting a family. Moving from working with institutional clients to individuals in many ways felt like starting back at the bottom after 10 years of growth that I had worked incredibly hard for. Despite that, I couldn't spend the next 10 or 20 years doing something that didn't feel meaningful. I first came into contact with Kuhn Advisors as a result of outreach from a recruiter on LinkedIn, but from the first meeting, it was clear that the level of passion that Mark has for our clients and how that this team stops at no ends to help clients achieve their goals. Since my arrival at Kuhn Advisors, this has only been reinforced. I've heard stories of Mark flying all the way to Australia just to get a signature from a client, or more recently, flying to Alabama to help a client's child with their business. This is inspiring and defines the ethos of Kuhn Advisors for the type of people who work for you. I didn't quite know all the details at this point, but I knew I wanted to work for someone who embodied this level of dedication and a desire to be indispensable to the clients that we serve. After a successful first interview, I received a bit of a curveball, or maybe it was a fastball right down the middle. The second interview, as it turns out, was less of a conversation and more of a project. It would take place 3 to 4 weeks later, and I'd be given a case study across multiple areas of financial planning and asked to build out a full mock financial plan. I felt both elated and unsettled, encouraged by the invitation to a second interview, yet daunted by the prospect of building a full financial plan without deep expertise in certain areas. My experience had been rooted in investments with little exposure to broader considerations such as tax planning, long-term care, education saving strategies. So I rolled up my sleeves and got to work. Each evening after work, I devoted hours to strengthening gaps in my knowledge, meeting professionals in this field, and leveraging my network to gain access to certain software that would help me build a detailed financial projection for my case study. I explored every angle and ultimately produced a presentation of nearly 40 pages. May have been excessive, but it reflected my determination to earn the role. And while some nervousness remained, it was matched by a quiet confidence born of preparation. As I walked into the room to present my case study, I knew I was ready for the moment. As I moved through each slide, I could sense a connection between me and the team, and the room started to feel smaller, more intimate, more natural. There was comfort there. It felt they wanted me here as much as I wanted to be here. It was an experience I will never forget. I became more motivated than ever to go deeper, to further exercise my first thirst for knowledge to best serve our clients. So in addition to learning our philosophies, systems, and all the ways in which we serve our clients, I also began working towards the Certified Financial Planner designation. In that same year, my wife and I were fortunate to welcome our first son, Walker, in March. The big test and final stage of the CFP certification process was a 7-hour exam, which I sat for in March of 2024. For 3 months straight, I spent over 250 hours studying on nights and weekends and put everything I had into preparing for the exam. I have to pause here for a moment to thank my beautiful wife, Leah, for all of the support that she gave me and our newborn son during that time. It was not just a sacrifice for me, but it was a tremendous sacrifice for her, and I couldn't have done it without her. But I knew the effort would be worth it for my family and for developing the knowledge required to serve our clients with the expertise they deserve. In March of 2024, that hard work paid off when I received the news I had passed the exam. From day one, and in every meeting I've been a part of, the fabric of this organization has been clear. We are rooted in integrity, humanity, and responsibility to others. Through observing Mark's interaction with clients, I've been inspired by his humanity, the way he handles deeply personal and sensitive matters. Those are the same qualities I saw in my grandfather as I grew up, and the same qualities I strive to embody for my own family and for the clients we serve. Every day, our work with clients presents the opportunity to build, and that work is anchored by our investment philosophy, the same philosophy that was instilled in me early on by my grandfather. So what is value investing? At a high level, it's investing in quality businesses, trading at reasonable prices. Value investing is focused on buying stocks that are undervalued relative to their fundamentals, in hopes that the market will eventually recognize their value. As in Mark's first two shibboleths, valuations matter, and therefore, earnings matter. Growth investing, on the other hand, targets companies expected to grow earnings at an above-average rate, even if their current valuations are higher. Value investors tend to emphasize downside protection and a margin of safety, while growth investors are focused more on future potential. Heavy emphasis on potential. With growth investing, when earnings fall short of expectations, you often see a material re-rating of the stock. The downside protection and margin of safety, often associated with the value discipline, are particularly important for people who are close to and in retirement, as they look to turn their savings into an income stream. I'm going to take a moment here to walk you through a little bit of the data. But as you'll see on this chart, we've got roughly a 53-year time series. Growth investing is indicated in these yellow bars here. Value investing in the green bars. And you also have different categorization of large-size businesses, mid-sized businesses, and small-sized businesses. If we start with large growth investing here on the left, these bottom numbers are representing what you might see in any given year on the downside. The top figures here represent the upside potential in any given year over the same time series. And this middle bar here represents the compound annual return over that same time frame. What you see here is exactly what I represented in my earlier statements about growth versus value. You have, in many cases, more opportunity on the upside with growth investing, but of course more downside. As we look here at the value investing discipline on the large size companies, you see that downside protection indicated here relative to growth investing, so down less, and a little bit of a ceiling here on the upside. But what we find is when you hold through multiple periods, you end up having a better long-term compound annual return. That's what we're looking for. As we get down what we call the cap spectrum, or the size of the businesses, you could see even more downside here in the mid and small. But in each case, the compound annual return of the value style is higher. We like that. One area of portfolio construction I was less familiar with before joining Kuhn Advisors was the importance of diversification, another shibboleth. As Jay pointed out earlier today, we are all influenced by biases. One of the most common for investors is home country bias, or the natural tendency to favor what is geographically close to home. It stems from familiarity and a perceived sense of safety. This bias is even more prevalent today, especially in Kyle's and my generation. There's this growing movement online of this S&P and chill movement, or the idea that you only need to own the S&P 500 and nothing else. A big driver of that is another bias, recency bias, or the tendency to overweight what's happened recently and assume it will continue, particularly after the strong performance of U.S. markets since the global financial crisis. I'm going to take a moment with you all to play a brief version of my own mind games. It's the year 2000, and broad U.S. stock valuations are close to what they are today. There are 3 different investors, all with a nest egg of $1 million, and they were requiring $50,000 to withdraw per year, plus inflation, for their living expenses. The first investor is fully bought into this S&P and chill mindset. 100% of their nest egg is invested in the S&P 500. The second investor takes a more traditional approach, 60% in stocks via the S&P 500, 40% in bonds via total bond fund. The third investor is well diversified in an all-stock portfolio across U.S. and large and small stocks with a value tilt, and also held both international and large and small value stocks. So where are they today? Anyone want to venture a guess? Well, the S&P and chill investor sold the family farm in 2016 because they ran out of money. More traditional approach, 60-40? Anyone? They're prepping the farm for sale because they're down to their last $199,000. How about the well-diversified portfolio? $2.9 million left, almost 3 times what they started with. So admittedly, this is a cherry-picked window in time, and we know past performance is not a guarantee of future results, but I think this is a wonderful illustration of the positive benefits of diversification. With a core investment philosophy now serving as a foundation for a plan, we are now tasked with combing through the unique details and challenges that families face. As we move through time, there will inevitably be unexpected interruptions, a job change, a move, an illness, loss of a family member. There will be modifications to the plan and adversity faced. That is where we bring a sense of calm and direction. How fortunate are we to be a guiding light during turbulent times? Understanding these key details and what matters most to you allows us to make informed and intentional decisions, to both set you up for success and to protect you and the people you care about. The variables in your life have meaning, and our end goal is to ensure that we are optimizing for your unique circumstances. Many people come to us for advice and think we have direct answers to the specific problems that are directly in front of them. Our first answer is often, it depends. Should I have life insurance? It depends. Do you have anyone who relies on you for your income? Do you provide a service to your family, such as childcare, that would need to be replaced if you weren't here? Do I have enough money to retire? It depends. How much do you want to spend? How much should I have in stocks versus bonds? It depends. How much liquidity do you require every year? Or how would you feel if your portfolio was down 30% this year? How much should I be saving for my children or grandchildren's college? Depends. How much can you contribute? What type of university do you want to fund for? Or do you intend to fund for the full cost of education or some other amount? Over time, these informed decisions begin to compound, and that's what leads us to gratifying moments when we see the plan come together after years of hard work and challenges along the way. Witnessing the gratitude of a client who just paid for 3 of their children to attend their university of choice, all without saddling them with student loan debt. Getting to retirement and hearing, wow, I never thought I would be able to live and to give to the people and causes that I care about in this way. Or I'm so grateful to help my adult child who is struggling with some adverse situation. These moments are the reason that Mark, Kyle, and me tap dance to work every day. Over these last several years, I've taken some time to reflect on what aspects of my work truly gave me joy and what motivated me to be the best version of myself. I've come to recognize that an environment grounded in intellectual curiosity, one that enables my insight and perceptiveness to serve others, is where I experience the greatest sense of fulfillment and purpose. I've also come to realize that my brain is hardwired to see a problem, think in multiple dimensions, and understand the next order effects of how certain decisions can produce different outcomes. This work allows me the opportunity to continuously exercise these innate strengths in a way that is both challenging and meaningful. As I work through building a plan tailored for you, I see the forest through the trees to see what things may look like in 5, 10, or even 20 years from now. I leave you today with a quote from the aforementioned Warren Buffett, written in his last letter as CEO of Berkshire Hathaway. Greatness does not come about through accumulating great amounts of money, great amounts of publicity, or great power in government. When you help someone in any thousands of ways, you help the world. Kindness is costless, but also priceless. Whether you are religious or not, it's hard to beat the golden rule as a guide to behavior. This quote embodies the lessons I learned from my grandfather and is the core element of what has shaped the framework of our business. I couldn't think of a better place to build a career than Kuhn Advisors, and I intend to uphold the principles on which this business was founded and continues to operate today.